By its very nature, investing in stocks and bonds courts a certain amount of volatility. One of the top researchers in the field of systematic investing is Wes Crill. As Senior Investment Director at Dimensional Fund Advisors, he has spent decades studying the benefits of sticking to a globally diversified and highly disciplined strategy for building wealth over time. Thanks for taking some time out from your busy schedule today to talk to us.
Oh, of course, my pleasure.
You've written in the past that, quote, the probability of a positive return from stocks increases over time. Can you explain that? Might sound pretty logical, but could you give some more explanation to that?
Yeah, of course. And I think understanding the volatility in stock returns and the behavior of a premium like equities versus fixed income is really critical to having discipline and staying the course through turbulent markets. And so it's helpful to see, what does this premium look like? What is the likelihood of getting a positive equity premium over different time horizons? I have seen the notion touted that stocks are less risky in the long run. Sometimes that comes down to people are measuring, annualized compound returns over various horizons. What we actually see from the distribution of cumulative returns from the stock market is really the opposite, that the range of outcomes gets wider and wider as you go to long time horizons. That distribution can be very wide when you're talking about 10, 15, or even 20-year periods, as might be the case for an investor's lifetime. But the silver lining to this is the distribution itself is shifting to the right in the positive direction as fast, if not faster, than it is getting wider. So what that means is the probability of a positive outcome is going up over time. Now, it never goes to 100%. There's no guarantees when it comes to stock market investing, but we do see that the probability of even like a 15-year period, there's a very slim chance that you would experience a negative outcome from stocks versus bonds. And in fact, once you get out to about 184 months in terms of duration in the U.S. market, we've never seen a stretch that long where you had a negative outcome. And so it's good news for patient long-term investors that the odds start to stack up in your favor. But it is a reminder that when you're looking over shorter periods, you can see negative outcomes, and it's important for investors to stay disciplined and not overly react to those.
Yeah, and you're not trying to imply that stocks are less risky in the long run, correct?
Exactly. I think just the nature of the range of outcomes becoming wider and wider. If I have in mind, okay, well, I want to have a good sense of exactly how much my current assets are going to be worth in the future. The precision around that, just what the overall range of outcomes could be, is vast in terms of the dispersion at longer time horizons. So you're getting less certainty around that. But at the end of the day, if my goal is to grow my assets, implying I want at least a positive cumulative return over these time horizons, that probability does go up very drastically at longer time horizons.
Yeah, I think the long-term data that you folks have generated clearly shows that investment in the U.S. stock market, for example, as well as internationally, grows on majority of the time, vast majority of the time, over 1 year periods. And that's going back to 1926. Over 10-year periods, you have written that positive results have occurred 95% of the time. So that just reinforces what you've been saying.
Yeah, those are good odds. And, again, I think it also reinforces what we mean when we're talking about over the long haul. I know for many investors, I would probably include myself at times, we think of 1 year as being a long period of time. A 10-year period, even within the stock market, is still just barely what we would consider a long-term outcome. But you do see those odds stack in your favor once you get out to 10 years and beyond.
Well, thank you very much again, Wes, for your valuable time. Have a good one.
Thank you. You too.